In this video, I want to go over how I've been recently trading in the current market conditions. I've been seeing a lot of traders getting destroyed, losing a ton of money, and just failing to find consistency trading in these conditions. So I want to go over what I look for, how I've been trading it, and how I've been able to maintain a 74% win rate. I'm not a big fan about talking about win rates because they are irrelevant in trading. A win rate doesn't decide on how much money you win or how much money you lose. What's more important is your risk to reward. But I want to go over how I've been able to find these winning trades and what I'm doing right and what I'm doing wrong. That way, for those who are struggling to find good setups or good trades, could kind of figure out how I'm doing it. Maybe a light goes off in your head, and now you could take better setups because of what I'm going to go over in this video. Before we get into it, I'm going to post a link in the description below for my Instagram at Ameritrade. I definitely recommend everyone to follow me on here if you haven't already. I post daily trading recaps along with very good trading tips and tricks. I guarantee you're not going to find anywhere else on the internet. Link will be in the description below. You're missing out if you're not following it. But the first thing I want to say is the market is never constant. It's consistently changing. It's consistently bringing new ideas, new setups, and new environments that we must adapt and change to in order to see profits with these different conditions. There's a video in the course and I explain how the market is basically like the four seasons. We have summer, we have winter, we have fall, we have spring. You're not going to go outside in the winter time with a bathing suit on, or in the summertime, you're not going to walk out when it's 90 degrees outside with a winter jacket on. So us as traders, we can relate this to the market because we must adapt, trade differently, act differently, and spot different things in different conditions. Ones who have success are ones who could adapt, adjust, and conform to the current market conditions. Now, how do you do this properly? Not only journaling, not only reviewing, but just gaining experience to figuring out what works for you the best and what isn't working for you the best in certain conditions. Many are trading the same, many are not flexible, many are not adjusting, and many are very stagnant to old ways. The market that we might have seen 2-3 months ago is not the same as the current market we're seeing. So finding consistency, finding success, finding profitability all depends on how well you could flex and bend your rules to conform to the current conditions, which is what I'm doing and I'm going to explain in this video. Now, don't skip through this part. This is vital in understanding how I've been trading, but I want to explain that the market has been very choppy and we haven't seen clear direction despite us being in a downtrend, right? So just looking at this chart, this is from the middle of September. The market is in a clear downtrend. Lower lows are being put in, lower highs are being put in. We are in a clear downtrend. However, conditions have been very, very choppy despite this downtrend. Now, what I mean by this is the market drops, then we consolidate here, we move lower, consolidate again for about another 4 days. And this is about a 1.5 week period. And the market did move lower, but it was in a very slow paced manner where we've balanced for a few days, tricking a lot of traders expecting a larger price swing type of move. Fast forward again to the following week. This is late September now. The market drops. After that consolidation period, we move even lower. It's basically like a stair step, right? We're moving down, then we come up, but then we start moving down a little bit further, not really going down in a fast manner that you would like to see with large price moves. Now in this range, we're consolidating, we're in a tight range, moves to the upside fail, we move back lower. And if we were to look not only on an intraday basis, but also on a daily basis, the market creates a low, the following day we break the low and then bounce. Then the following day we break the previous day low, we fail to really find continuation, and then we get a strong rally to the upside. Then the market comes back down, tests the lower range, we break out, then we rally for about a 3-day period. So this is kind of like a roller coaster, right? We're going down, we're going up. Then we start rallying. Everybody's calling the market the bottom here. They're expecting a bottom, not realizing we're inside of a supply. After a 3-day rally, the market sells off and we move lower. And now in the current range, about the middle of October, where basically we're just consolidating in a very tight range, moving down, putting in lower lows, putting in lower highs, but failing to find follow through and continuation below a balanced range low or below a low a day or a weekly low. We're failing to find that continuation and that follow through, which is not a good sign, especially if you are a trader who is looking to capitalize on a larger time frame and a larger price swing type of move. Now, we have a few exceptions to this. Obviously, last Thursday when the market had the CPI news, and then a couple other days when we had strong rallies that I just mentioned. We see some days where we see large price moves. It's not like non-existent. However, they've been less frequent, and we haven't seen them be consistent in the market, where those who expect the market to range and trend up or down, it really doesn't matter. Those are the traders who are getting caught up because they're expecting a bigger move when the conditions really do not permit for that, as we haven't seen consistent large price ranges with strong volume and strong continuation. So how I've been viewing this is holding for a continuation for a trend for a longer type of trade, day trade, has been difficult. With this being said, scalping has been easier, and I've been scalping a lot, or pretty much all of my trades, fast entries and faster exits, looking to capitalize on a smaller portion move on an intraday basis. But those who scalp have been having a better edge than those who trend trade. Now, again, there's going to be some who trend trade and have taken really good winning trades. I've taken some trades that ended up as trends that have worked out well, but the point I'm trying to make here is they haven't been on a consistent or an easy type of trade basis where they're easy to spot and easy to read. My scalps, I've significantly sized down in this market, and I've been trading less, focus on high quality setups, yet I've been still making more money and capitalizing on some moves, even though I've sized down and have been trading less, focused on non-quality setups. This is different from the market that I was trading in 2 months ago or a month ago. So the biggest thing here I recommend everyone to do is size down if you are failing to find profits, or you're failing to find the conditions easier to read, or they're just hard to read in general, or hard to find high quality setups. I recommend sizing down. That will be a solution to a lot of everybody's problems. Now, in these conditions, the first setup that I look for, since the market is in a downtrend, is shorting inside of supply. Supply zones work the best in downtrending markets. However, in this example, the S&P 500, pull up the pre-market plan here. I post my setups I'm watching every single day in my Discord, levels I'm watching, setups I'm looking out for, and potential trading scenarios. This was early October, October 6th, and we were watching the market to reject this key supply at 3,812, and I said if it remains key, if we want upside prices, no continuation rally will come below this 3,808, 3,812 level. If we could reject this area, sellers going to come into the picture and the market may pull down into the demand zone lower. This was my setup on October 6th. The market came into the supply zone. I had a scalping mentality. And if we were to go to a 1-minute chart, what I basically saw was the market rallied inside of the supply zone. I actually took the market long into the supply zone. I saw some selling activity inside of the supply area. I saw a break of structure, and I took the market short with a stop loss above the high, targeting this little consolidation area right here, that once we hit this level is when I got out of my full position for a quick little 1-minute scalp, capitalizing on a very fast move in the market, scalping off of supply, shorting this move, targeting an area of structure to the downside. Now, this is going to be a perfect example of where if going for a larger move would have still worked out. Maybe you consider this a trend, maybe you consider this a scalp, but the market basically found its high a day at this supply zone. We put in a lower high, we broke the following structure, and we began to sell off even further into this demand zone. So my mistake with this trade was I sold way too early. I did not capitalize on the larger picture move, but it was a quick 1-minute scalp where this setup worked out right in my favor. And again, shorting the market in a downtrend at supply when rallies fail is the highest quality of setup that we're going to see in the downtrend, and these higher time frame examples show this point exactly. So there are some times where the market may sell off after not rejecting supply. So sometimes we don't hit supply and the market does bleed and the market does sell lower. So in order to capitalize on these setups, the next thing that I've been looking for is a break below structure using demand lower as a target to price. Now, from the pre-market plan, this was the following day on October 7th. The day that we rejected that supply zone, the day prior, had a nice sell-off from that. Now, the following day, we could use the context that the market rejected supply. Context is very important. If you don't use market context, it's very difficult to get a good read on other participants in the market auction, and you're going to be very stagnant and you're not going to put the pieces together. Context is key, and you develop context by understanding the position of other traders. So if the market's selling off, especially on news, not finding buyers at this demand zone, this is indicating a sign of weakness. So from the pre-market plan, what I posted was, as long as we remain below 3750, 3735, which is this white little box up here, I want to lean on the short side, targeting 367, 3656 demand, which is a level from earlier in the week. So I knew that if we remained below this white box on a market context perspective, I can't be bullish. In fact, I'm going to look for ways to be bearish, targeting demand lower, as you can see from scenario number one. So I saw the market basically come down. We didn't find any buyers at this demand zone. We made this little structure over here, sold off lower, broke this demand zone. I removed this one, I removed this one, and then at 9:46 is where I entered the market short. When we started to come up, filled in this drop. Sellers on this drop got tested. I got short on this range, targeting the demand zone lower, putting in lower lows, lower highs, and I used this little breakout of structure right here. Some could even draw something like this, where we broke out of this, get short, targeting the demand zone lower. Not only is this going to prevent me from getting long at demand when the context doesn't agree with it, but it's also going to help me capitalize on a downside move if the market is not rejecting supply, or we're just having a downside type of continuation on a quick little intraday basis. Now the market consolidates at this demand zone, right? We put in a low, then the market moves higher, then we move back lower to test the previous low at this demand zone. If this little rally off of the demand zone does not come higher than this little previous high right here, this structure is basically a consolidation before a next move to the downside. This is going to give us an indication that the market may want lower prices if we cannot rally above this little previous oval right here. That's going to indicate that not only buyers over here are weak, but also buyers over here are weak. And then this is going to be the same exact scenario that I took earlier. We can look to take the market short on a break of this little structure right here, targeting the demand zone lower. And this setup would have worked out very well. We put in lower lows all day, put in lower highs, and this was being able to capitalize on a structure break using demand or support below it as a target to price on our short position. Now, to capitalize on an upside move, reversals at demand in downtrends are always lower quality of a setup. You don't have to be a first buyer, you don't have to try to catch a falling knife, and you don't have to try to call a bottom. You just want to trade on the same side as buyers if they are buying at lower prices. Now, what I look for is a retest of buyers at demand instead of being a first buyer. So the market sold off into this demand zone. We tried to move higher, then we pulled back, and this retest held the previous structure. And this is when I got the market long, stop loss above the high, target supply to the upside. So now, if you go back and test this on downtrending markets, demand zones are not met with strong buying. They are met with a temporary relief bounce or some type of consolidation before a move lower, as you've seen in the past examples. So with this, and instead of trying to catch a falling knife or try to take the market long and be a buyer on weak conditions, I like to let the market bounce and play a retest. You could see this on the tape. You could see this on a 1 minute chart, 5 minute chart, 30 minute chart, 4 hour chart. It doesn't matter what time frame you look at. The concepts, no matter what I am explaining, will apply to higher time frame, lower time frame. Just depends on the type of trader you are. So in this example, I've seen many examples where the market hit demand, we tried to move higher, and then this move higher fails, and we continue to sell off and bleed even down further. That example I just mentioned earlier did that perfectly. So instead, what I'll do is I will wait for the market to retest demand if we get a strong reaction out of it. I don't have to take every move. I don't have to try to catch a bottom. The market could rally here and I can miss the setup. I don't really care, because what that will do is if the market does rally, it'll provide structure for a potential trading scenario tomorrow or maybe next week or some point in the future. Everybody's watching the market on a daily basis and thinking they have to capitalize on every single move up or down. It's false. You capitalize when you could read the market properly and your edge is present. So in this example, I was looking to, I like the action here at 3587. I said I was in long, stop loss below the low, and I was going to target $3,600 break and then high a day because those were the two areas of interest. And then I had multiple pieces of a confirmation that gave this setup more conviction. The more confirmation you have, the higher quality of setups you're going to take. And I like playing retests like this, indicating buyers are interested after the market moves up. And this is when you're going to get a higher quality setup to the long side, especially off of demand in a downtrend. And to indicate why it's vital for you to have a plan, this was my biggest loss so far this month. And it skews my wins to my losses because I did not have a plan with this setup. I didn't have a valid reason for entering. I got long when the market was balanced. We broke the low where I usually sell my positions, and I kept holding this position until the market really was giving me my max pain, and it was indicating lower lows, lower highs on an intraday basis. The mistake with this setup was I didn't have a plan, I didn't have a valid reason for entering, and I paid for the result. And this was my largest loss in the past month so far. And the point I'm trying to say here is have a plan before entering, have confirmations, and if you don't have either of those two, you should not be trading. And momentum to the upside, when I'm scalping, I look to capitalize on momentum. I only trade when I expect momentum to come into the market. It's vital. If I'm scalping, quick move, I need to see momentum or else it's not going to work out. And I've been trading futures because of these choppy conditions. Options have been less favorable in my arsenal. I still trade them, I still use them, but futures have been working better than options for myself in these conditions. Now, last setup is momentum to the upside, a break of a key level, and using supply as a target. I'm scalping, so I want to capitalize on a quick move. If I see something in front of me, I'm going to take it as long as the risk makes sense and the risk reward is in my favor. So scenario number one, we are watching for a breakout above 3639. We're going to be looking for ways to play long, targeting supply zone above at 3686, which is a key resistance for upside prices. So essentially what happened was the market broke out, hit this resistance, pulled back, and then broke out above it with strong buying volume, targeting supply above. As soon as you hit supply, I exited my full position, and it was a quick little resistance break. This is how I've been trading recently. I've been not taking many losing trades because I've been focusing on only quality setups. There's some days where I take no trades, and there's a lot of days where I take one trade or one or two trades. The trade that I lost the most on was one that I didn't have a plan and I didn't have confirmations. And the other trades that I lose on just didn't work out in my favor. But as long as you maintain a proper risk to reward and focus on quality setups and focus on what works for you the best, that's when you're going to see consistency and that's when you're going to see profitability. So win rates are irrelevant. I don't brag or boast about a 74% win rate. It's irrelevant. You could be profitable with a 40% win rate or a 50% win rate. That's impressive to me as long as the risk ratio makes sense in your favor. And I hope this video helped. If it did, drop a like, hit that subscribe button, join the team, and definitely check out the links in the description below. But I'm ending it. Peace out.